Welcome to Tech Talk Tuesday. I'm your host, Carla, and with me is my fellow co-host and CMT, David Blake. It's Monday, July 22nd, 2024, and we have some activity to talk about that happened in the stock market last week, along with some interesting things to look out going forward. We do it mostly from a technical perspective. David, I hope you had a great weekend. How are you doing today?
I'm doing well. I had a great weekend at golf.
Oh, good. Good to hear. Hopefully you won or hit some good
We did.
numbers.
I did very well.
Okay, great. Well, let's take a look at last week's market letter and then we'll jump into what we can look into moving forward.
Okay. The market letter said 2 weeks ago we were in the midst of the great rotation, and that happened again last week. We saw a little bit of that. We saw investors coming out of the big cap technology and AI related stocks, and they moved into the small caps and more cyclical areas of the market, which we've been hoping was going to happen. As you know, the regular S&P 500 is up about 14-15% year to date, but the equal weighted S&P 500 is only up about 6%. And that's because the big Magnificent Seven, their overweighted ability in the regular SPY or S&P 500, they make up about 30% of the weighting on that index, and that's why it's up so much. And in fact, they're going to report earnings this week. Their earnings are going to be up about 50%, and that's making the actual earnings estimates for the second quarter to be up around 9.5%. Without that, earnings aren't anywhere near about 9.5%. But things are looking better here in the second half of the year as we get some rate cuts. But anyway, starting out on Monday, Fed Chair Jerome Powell came out and he basically was looking at, he said we're getting towards our 2% mark. Looks good. The job market is pretty much back to pre-pandemic levels, which is good for inflation. That means that the economy has slowed down a little bit on that. We also had some strong earnings came out, and we also had the yields move a little bit lower. So we kind of had a trifecta for equities, which gave stocks a pretty nice boost. The Dow was up almost 1,200 points coming Monday through Wednesday, 3%. That's a big move for the Dow Jones. And then we had the small cap Russell 2000, which was up 11.5% previous week, also had a nice surge. They all pulled back on Thursday and Friday, but the Dow and the small caps, and I believe the transports also finished the week higher. That was second or third week for the Dow. Then we saw the NASDAQ because it's overweighted with the big caps coming down. The NASDAQ actually snapped a 6-week win streak. So that was something that, you're going to have this backing and filling at all times throughout the market. So it wasn't anything to get real excited about. We've been talking about that things were been overbought by several measures. Stochastics were up in the mid 90s. We had 14-day RSI, which is a momentum indicator, and also measures overbought and oversold conditions. That was up in the mid 80s, which you don't see. Anything over 70s considered overbought. So you had a lot of momentum has pushed this market a little bit too high. We needed some backing and filling. We'll see how this week goes. In fact, on Wednesday, the NASDAQ was down 512 points. That's 2.77%. That's the worst session since December of 2022. So it cleaned the table a little bit with that selling. We also had, as Trump popularity went up a little bit, we had a nice big move in cryptocurrencies. Trump was considered more relaxed with cryptocurrencies. And so we saw Bitcoin, I think, jumped up around 13% last week, which was good. We're back up around 67,000. Not sure what it's doing today. We had oil hold above $80 a barrel. I think today, I'm not sure why the oil's selling off today, but it fell back below $80. We'll kind of keep an eye on that just to see what's going on with that.
Okay, and which sectors of the market were the laggards and which ones were the leaders?
As far as the market sectors go, they were mixed. We had energy, financial, REITs, and consumer staples outperforming. And of course, then tech was the weakest sector. It was down 5.5%, which is a big drop with that. And then utilities were lower, and that's due to alternative energy stock being sold, kind of the green stocks and the wind solar stocks and wind stocks, that type of thing. That's because they figured that if Trump takes the lead here, they'll be less friendly towards those kind of industries. So I wouldn't be trying to trade or jump around with the daily activities, whatever. You don't know what they're going to report. So I would not even think about trading off of candidates and stuff for the Democratic Party or what's happening with the Republican Party either. Okay, so after that, we also had on Friday or Thursday, I'm not sure. We had CrowdStrike had that tech outage with their uploading of some new software, and that's continuing again today. I don't have it right in front of me, but I think CrowdStrike is down another 10-15% today. It just cut right through the 200 moving day average. Yeah, we're at 264, down another $40 today, down another 13%. That's going to weigh on the tech sector, but in general, because of the big caps bouncing back, tech sector I think is kind of leading this rebound today. Let me check on that. Yeah, tech's still up 1.1%. Communications services are up today. So the tech's bouncing back with the big caps. So CrowdStrike thing's not really having a big weight on that sector as of right now.
Okay, and how is the technical condition of the market doing?
As far as the technical condition of the market goes, we did see some deterioration last week, not a lot. We were overbought. We did see some of the indicators pull back from overbought conditions. We did also saw MACD on the S&P 500 and NASDAQ cross over into bearish territory. We may get a cross back into bullish territory. So it's kind of going along kind of neutral as far as momentum goes on those two indexes. We'll have to see what's going on. We also did see the S&P 500. It came down. It did find support at a rising trend line last week at 5,500, 5,510. If you go on our smart chart module, you can actually draw that in from back in the fall up through lows over the last couple of months, and you'll see that there's a nice rising trend line for that. There was a little bit of trouble with the NASDAQ. The NASDAQ broke its rising trend line at around 17.9 on Thursday, and it was unable to get above that on Friday. I think we're probably above that today. I haven't checked the chart yet today. Watch that. If the NASDAQ can get back up above 18, maybe we can get a little bit of follow through on that trade. We'll have to see. Good note from last week, though, is the fact that the secondary indexes outperformed the S&P 500 and the NASDAQ. So that's usually, you'd like to see the small caps and maybe transports kind of lead the way, and even the semiconductors, but they were hit pretty hard last week. The semiconductors were down about 8.8%, and they were the first index right now to have broken the 50-day moving average. So that's something on Friday that you want to watch. Traders are going to watch to see whether or not, even with number one, we're having a little of a bounce today. Is that going to get up above the 50-day moving average and start to make ground, or is that going to become a resistance area? We're going to have to bounce off of that a little bit before the semis can pick things up. So kind of watch that. Technology, materials, and utilities also are coming down towards their 50-day moving average support levels. They're the first three that show signs of this negative divergence that maybe is pointing to a weaker market. We'll have to watch on that.
And how is the underlying market breadth doing?
Now, funny, it's with this pullback last week. I've been talking about the weak underlying breadth, how it's been expanding a little bit. Well, last week we actually had a pretty good underlying breadth week. We had new highs outpaced the new lows. In fact, probably the most in more than a year or so. We had 604 new highs in the NYSE versus 31 new lows, and we had 712 new highs on the NASDAQ versus 178 new lows. 712 new highs on the NASDAQ that shows that we have new leadership in this market. Just 2 or 3 weeks ago, you were getting like 200 to 300 new highs in the NASDAQ, and you were getting like 350 to 400 new lows. So that was quite a turnaround on that. Let's see. And then with the NASDAQ, the AD line, we did see that lose some units. It lost 1,500 units. The New York AD line, I think, lost about 300 or 400, 500, something like that. No big deal. But just to add something in here real quick, if you saw the market posture, we did go bearish posture last week with the CTI negative. It actually had gone negative the week before, but I kept it at a neutral. And one of the reasons before is, we have these cycles that run through the market, and you can read about them. And you go up to the right-hand corner under manage, you'll get some different studies to look at that we have written up there for help. But the cycles are kind of like sine waves that go through underneath the market. Now, but the thing about it is, these sine waves aren't exactly even. When we project them out, and it's a forecasting model, we do kind of figure out, okay, well, we're going to go out 40 days, we're going to go out 80 days, we're going to go out 18 weeks, we're going out 36 weeks, 72 weeks, this type of 216 weeks. But the peaks and the trials are not always right in the middle. You don't go out 9 weeks and then all of a sudden the market starts going down. It could peak after 12 weeks and then start to go down. It could peak after 10 weeks and then start going down. So you have to, that's why it's more like an art rather than an exact science when you try to manipulate these cycles for the CTI and for the market posture off of that. And in this case, like a lot of times when I bring these up, I will see negative divergences or positive divergences, which are telling me, okay, this thing is probably already peaked, and we should be starting down here within the next week or two, or we should start to rise in the next week or two. And in this case, it's been really hard to pinpoint, where the peaks of the trials are, mainly because of this overweighting of the big caps. But I think we're in pretty good shape right now. Historically, August is a weak month, so is September. And the CTI is positioned right now to I think this week we're going to be at a -4, and we go to a -6 after that. And that's telling you that probably we're going to see some more weakness going out over the next several weeks. Certainly we have enough things going on politically, at least, and even in some of these wars around the world to give you a reason for pause and to be cautious. So I would not be chasing anything in here. But I get short, I don't know. I don't see enough breakdown yet to consider going short the market in here yet. We did break some of our FLDs. We're bouncing up today. I want to see whether this holds. If we do not hold this bounce today, that would probably be a sign that would be a bearish sign for the market. Then I would start to consider that maybe we are going to go down a little bit more. Last thing I want to bring up real quickly is that there was a little bit of a study that I looked up, but I put in a letter last week out of Meter Investments. Their chief investment officer, he reported that over the past 9 initial interest rate cuts, more than half the time, the S&P 500 dropped on average 20.5%. Now, fortunately, 6 months later, the market was usually higher by about 3.4%. Now, we've pretty much priced in a rate cut in September and also another one in December. And a lot of people think, okay, as long as we cut rates, great. The market's going to go up from there. That's not necessarily the case, and that's one of the reasons is you have to pay attention now to the jobs data, because this, when you start to cut rates or raise rates, if you look at the economy, it's kind of like a big ship coming in the dock. Once you've got that momentum coming in, if you pull back on the lever too late, you're going to run into the dock. The fact that all of a sudden we start to see the jobs market soften too much, and that means that perhaps the Federal Reserve has waited too long and left rates too high. Now, another thing coming up is you're probably in September going to get a lot of people saying that a rate cut is politically motivated. That could put extra pressure on the Federal Reserve to possibly wait a little bit. I don't think it's going to happen. I think we still will get a September rate cut, but then in November they'll wait until after the election to do a second rate cut. So again, right here, I would look for the market probably to do some backing and filling. Today would be kind of a sign that if we don't see this initial pop here hold, that would probably mean that we could see some more weakness throughout the week. Would say that we've got a busy earnings week coming up here. We have Google tomorrow. I think Tesla tomorrow. We have Alphabet's tomorrow. That's right. And then IBM comes out on Wednesday. We have Coca-Cola on Wednesday, I think. Bristol Myers, we have AbbVie, we have Colgate-Palmolive. A lot of big companies coming out. And then later on in the week, on Thursday, you want to kind of pay attention to the economic data there. We have the second quarter GDP coming out. Right. Currently, they're looking at about 1.9% growth on that. That's following first quarter GDP of 1.4. So that would be a little bit of improvement on that. The market should like that. I don't think we'll see much surprise one way or the other on that. But the big news coming up is going to be on Friday, and that is the June PCE. That's personal consumption expenditures. That is kind of the Fed's big deal that they watch to see what's going to happen with inflation. Now, I think the headline number, we're looking for 2.4% year over year increase. And for the core PCE, which strips out food and energy, for a rise of about 2.5%. That's down only from 2.6% in May, but again, it just continues to show that the trend is lower. Any surprises there could move the market. I don't expect to see an uptick on that. If anything, maybe it comes in a little bit better than anticipated. But again, that would be the big news that Thursday and Friday, those economic reports. And I think that if we do get a headline and the core meet expectations or even come in a little bit softer, that should be the final piece of data I think the Federal Reserve would need to go ahead and ink in a September rate hike, which, as long as we do some backing and filling in here, at least can probably keep a little bit of a bottom under the market going over the next, say, 6 to 8 weeks.
Briefly touch base on the market posture change, but I was just curious to ask you, David, is this common for the market posture to change so quickly? I guess you already mentioned what kind of factors you saw to change the market posture, but I was just curious to see if it's common that it changes so quickly.
Well, yeah, it is, and it's not that we just all of a sudden pop up there. If you go to the home page and let's take a look at On the Edge. This is published on the first of the month. Here we are there. Well, stocks wilt in the summer heat. Let's go ahead and take a look at that. And Rich does this every month. And go start heading down to the bottom of the page. And when you get to the table, okay, there we go. Keep going lower. Keep going down. A lot of interesting charts in here that you can take a look at and see how, what's going on with the sentiment and the momentum and that type of thing. And here's the bullish thing that's been staying real crazy over there. But here at the end of this, and here's what you're looking at right there is the market posture performance going through here. But go ahead and go on up a little bit more. There we go. Okay. Now what we do here is a cyclical trend index. It's about a fourth of the way down when you go to the On the Edge, and we actually publish this looking forward. As you can see, we had in there. This is from July 1st. If we kind of could go out maybe 4 or 5 weeks ahead of time, to at least to the end of the next month, and you can see that we were projecting that the market CTI would go bearish. Again, what I need before I go into a bearish market posture, just because the CTI changes, I need to see what the momentum index is doing and the sentiment index is doing. If the CTI goes to a -3, -4, and the momentum index is still at a positive +6, which it was, I believe, +4 the first week that we changed to a negative reading, then that means that the cycle, the peak, and we just talked about the peaks and trials in these sine waves. That means that the peak of this sine wave is going to be extended a little bit further out. But you can at least see that, okay, well, we're going to be going negative in here. Perhaps this next peak in the market may be where I want to start putting on a bit of hedging for a downturn in the market. And this will keep you from being just caught off guard, saying, wait, you've been bullish for the last 2 months, now you're bearish. I missed that. This will give you a little bit of a heads up to what we're looking at going forward. And so you're not caught off guard. But then just know that just because it says it's minus or a plus, there are other considerations. It's not a black box. We have to look at, again, the momentum index and the sentiment index. And I also want to see maybe some negative or positive divergences in some of the other indicators that I follow to know that we're going to make a bullish or bearish call on the market. And if we went to a neutral because it just seemed like the momentum index was too high for it to start to roll over, and that's where you can find where that was done.
Great. Well, that gives some insight on what's ahead, definitely. So we are kind of almost running out of time, but I just wanted to take a quick look and catch up to see where our market sectors are and how they're doing. I just wanted to go over here. I have a stock watch list of all the SPDR sectors.
Okay. One of the things you can look at here, we did downgrade a couple of them, consumer staples and utilities. I think I just mentioned that a bit ago that we did see the utilities heading down towards this 50-day moving average. And if you put your cursor over on utilities, so there you can see that utilities actually broke below its 50-day moving average there, I guess last week sometime. So that's something we want to take a look at. I think you're going to see more of these starting to be downgraded going forward. Go over a little bit more. Look at that 50-day Redo strength. Now this is something that you want to see, that you want to also look at. What this means, if you look at this, okay, starting to the top, the materials are underperforming S&P 500 by 7%. You have energy underperforming by 7%. If I'm looking at I'd keep my eye on these things. And when you get to about the sectors, when you get to about a 0.96 and lower, especially if it's on the way down, that's a sign that that sector is probably going lower. As you can see here on the consumer staples, you got it at 0.96, you have utilities at a 0.95. It looks like industrial is still long, but it's underperforming the S&P 500 by 5%. And even though energy was upgraded at a 0.93, I would be weary of that because you're still only at 9.93. I would have to look at the chart to see whether or not, if that was just like at 0.90 a couple weeks ago. See if you can get that chart up. Okay, yeah. So we've had this big pull down. We did get a bounce here, back up. It bounced off the 200-day moving average. Let's see if today we're lower. Let's see if the energy is going to hold that 50-day moving average or not. So that would be something that we would want to watch. If it comes back down and closes below that 50-day moving average, that's going to be a sign that you don't want to be in there going quiet. Now, and with that being said, I do like the energy sector in here. I own oil stocks, and I think if we get a pullback to the 50-day, you may see this thing, find support there and start bouncing up again. So you can watch that and just to see what the power rating is and the 50-day relative strength, to see where they're going. Once they get above 59, that generates an upgrade to a long. Once we get all the way back down to a zero, that's going to trigger a downgrade to a neutral. So as you see these, if you're sitting there watching, say, financials, we're strong at an 80. I like the financials in here right now. You start seeing that getting down here around 45 or so, then you're knowing that sector is beginning to show signs of deterioration. And then you can kind of look at some key support areas to see whether or not they're going to hold or not. If it breaks, then you got to start thinking about taking some profits in these.
All right. Well, great to know. Let's see. I guess we are running out of time. Is there anything else that you'd like to quickly add?
Yeah, one last thing on there. On that tech sector, Spider, you can see that it broke the sell stop on second opinion last week over on the right-hand side. And that's, you kind of want to watch that. We did break the 50-day moving average last week on Friday. We're getting a nice bounce today. A lot of traders will look when they see something like this, the moving average thing break down. They would like to see the thing, if they're looking to get short here, they would like to see it maybe get 2 days where it trade 2 or 3 days where it trades below that 50-day moving average. Then they're going to make their move. If it just goes under 1 day, then bounces right back up. They're going to keep watching that to see whether or not it's bouncing off support or whether it hits support, held, bounced up, and then we're going to continue on down. So you want to watch this tech bounce that we have today just to see whether it's going to hold whether it's just a 1 day dead cat bounce here, or and then we're going to start lower, or whether we actually are going to bounce off this 50 days moving average and find some support, and again try to work a little bit higher from here. I think we're going to continue lower in here. So that's just my opinion. And you watch that to see whether or not we hold that 50-day for the tech.
Okay, we'll definitely keep an eye on that 50-day moving average. David, thank you for all the helpful information. We do have to wrap up this week's Tech Talk Tuesday. We want to thank you to all of our listeners, and we will catch you guys next week.
Sounds good.